In 2015, through a challenging economy, Morguard Real Estate Investment Trust once again delivered solid performance and stable cash distributions, the result of focusing on the strength of our portfolio. In 2015, Morguard Real Estate Investment Trust generated steady funds from operations and maintained its record of delivering reliable monthly cash distributions to unitholders. In 2015, the Trust distributed 96 cents per unit, and the Trust's payout ratio was 75% of adjusted funds from operations. One method for benefiting unitholders is to increase their equity interest in the Trust by reducing the number of outstanding units. In 2015, the Trust purchased more than 1.3 million units for cancellation. In 2015, the Trust generated basic funds from operations of $1.72 per unit and basic adjusted funds from operations of $1.28 per unit. Prudent capital management is a strategic focus of the Trust. Improved property values allowed the Trust to obtain additional capital. During the year, the Trust secured $56.2 million of financing, of which $27.7 million represented new capital. The Trust's weighted average interest rate on mortgages and debt was 4.1%. This continued its four-year reduction, down from 5.3%. The Trust's consistent funds from operations is aided by the strategic diversification of its portfolio of commercial real estate properties. The portfolio is diversified by geography, with properties located in 6 provinces. The portfolio is also diversified by type of asset, with a total of 50 income-producing properties, generating net operating income in the retail, office, and industrial sectors. The retail portfolio includes 7 enclosed regional centers and 13 community strip centers. A key strength of the Trust's retail portfolio is its stake in dominant enclosed shopping centers in secondary markets. Of the Trust's 7 enclosed regional centers, 4 are particularly dominant in their area. They are community hubs with a social draw, providing high foot traffic and high retention rates that reduce the cost of leasing and tenant turnover. The combination of a solid location and a diversified mix of service and fashion delivers strong and stable cash flow. Another key strength of the Trust's retail portfolio is its stake in community strip centers. These centers, the majority of which are grocery anchored, are right-sized to service their primary trade area. Characteristics of the centers include specific services, long-term leases, and high occupancy. These community strip centers provide strong financial performance and stable net operating income. The other major component of the Trust's strong portfolio is its holding of 24 income-producing office properties, comprising 3.5 million square feet. Overall quality is a major strength of the Trust's office portfolio, with well-located properties in major cities across Canada. An example of this is a large landmark building in downtown Calgary, Alberta, initially developed for a financial institution. In August 2016, National Bank will take possession under a long-term lease for its private banking division. This deal validates both the quality of the property and the strength of the Trust's management team for securing a AAA tenant with a long-term lease in a challenged market. To maintain the strength of its portfolio, the Trust regularly makes capital investments through renovations and upgrades to the merchandise mix in its retail properties. In its 2015 development program, the Trust completed or commenced 3 primary projects. A $2 million strategic re-merchandising at Heritage Place in Ottawa, Ontario, to support a new Winners location in the Class A office building. A $15 million re-merchandising project started at Parkland Mall in Red Deer, Alberta, undertaken to leverage a new lease arrangement with Good Life Fitness and Fit for Less by Good Life. And a $25.2 million renovation completed at St. Laurent in Ottawa, Ontario, the Trust's largest retail property. The renovation of St. Laurent aptly demonstrates how the Trust's retail portfolio is both maintained and improved. Built in 1967, St. Laurent has been a destination retail center in Canada's capital city for nearly 50 years. Now the renovation has increased its competitiveness, enhanced its focus on fashion, and improved the customer experience. With the arrival of light rail transit in 2018, combined with master planning studies on adjacent land, Saint Laurent is poised to take advantage of anticipated growth. A notable change for the Trust's retail portfolio was the exit of the US-based Target chain of stores from Canada. The closures offer the potential to enhance tenant mix, increase rental rates, and draw new traffic. 3 new anchor retailers are already open or soon to open. In the first quarter of 2016, the Trust commenced its redevelopment of its remaining 4 locations. The redevelopment will result in the larger single-use spaces being redemised to suit multiple new tenants, including specialty retailers. For the Trust, redevelopment of the vacated Target Canada space is expected to increase revenue and improve cash flow over the long term. To optimize performance of the Trust's portfolio, from time to time, management may acquire properties. Alternately, the Trust will dispose of assets where the potential for future cash flow is limited. During 2015, the Trust disposed of 3 investments and generated net proceeds of $30.1 million. These proceeds, combined with the additional capital from the Trust's financing program, were used to complete development work and purchase units of the Trust for cancellation. The Trust closed 2015 with $26.3 million in cash reserves available for reinvestment to enhance the portfolio and improve performance. Clearly, the underlying strength of Morguard Real Estate Investment Trust is its diversified real estate portfolio. In total, the portfolio of the Trust includes real estate properties valued at $2.9 billion, with a total of 8.8 million square feet of gross leasable area.